Last up is Kevin Prouty, U of A graduate as well. Currently a production analyst with CBRE's debt and structured finance team. He focuses on all asset types and specializes in multifamily, particularly with Freddie Mac small balance loan program. Kevin?
All right, so I'm going to update everyone on the lending trends we're seeing in 2017. I'm going to try and get through this quickly because I think I'm the last one holding this up here. I'm going to go through the four major property types as well as the main lending types. In general, lending conditions for stabilized assets are good. However, there are a lot of lenders that think we're near the peak. Starting with multifamily, this is where you see the domination by Freddie and Fannie. You see the benefit of the implicit guarantee that backs multifamily loans or agency loans. Agencies can offer 75, 80% loan to value, lowered rates, lower debt coverage ratios. It makes it really tough for the other lenders to compete here. I also wanted to single out the Freddie Mac small balance loan, which is a fairly new program. It's a great fit for Tucson. 1 to 6 million, kind of designed for B and C class properties, which is an area that Freddie and Fannie really struggled to compete in the past. Helps local owners get the same terms as kind of the institutional owners. 30-year amortization, up to 80% loan to value, non-recourse interest-only periods are all available. So it's really a great program. Looking at retail, retail concerns lenders a lot right now. The traditional grocery-anchored center that has historically been a staple for lenders is now causing a little concern. Many announcements, such as the Amazon Whole Foods deal, is just the latest factor that is giving lenders a little bit of pause right now. Lenders have become very selective in terms of what retail properties or anchors they will even consider. You know, a lot of second-tier grocery anchors, which they may used to consider strongly, they now have a lot of hesitancy. That concern can be seen in higher interest rates, as well as higher debt coverage ratios across all lender types. Our CBRE head of research looks at the trends in retail because there are a lot of investors that have completely pulled out of the market. He thinks it's the biggest overcorrection he's seen in his 30 years. And he believes that retail fundamentals are currently much better than the chatter you hear about. However, that's not completely reflected in how lenders are looking at retail at this time. Office is very similar to retail. Many lenders are hesitant on the office market, really view it as a case-by-case basis. It's kind of tough to get major trends on how they view office right now. Construction lending, particularly tough in the office market as well. Now, industrial is currently the golden child for lenders. They love the predictability of industrial properties. They love the role that industrial properties are going to play in our economy going forward. They like how e-commerce is driving distribution demand. Because of that, life companies and banks are really willing to stretch on industrial properties. They'll go to higher loan to values and lower spreads than they will on other asset types, which makes it really tough for CMBS lenders to compete there. Their only way to compete is on higher proceeds. But of course, that comes at a higher rate. Looking at the lender types in total, you can see there's still plenty of capital in the market, although lenders are starting to be a little bit more conservative. They're leery of issuing loans at the very top of the market, so they're starting to pull back now. Max leverage loans still available through CMBS. However, what used to be 75% what they would sell to their investors, they now want to be selling 69 to 72% LTV. It looks a lot better for the optics. Again, I want to point out here the difference that the implicit guarantee of agency loans carries, because CMBS and agency lenders, who are traditionally our max leverage lenders, agency loans can offer, same higher proceeds at a lot lower rates and a lot lower debt coverage ratios. Looking at our conservative lenders, which are traditionally banks and life insurance companies, banks are able to offer higher proceeds. They mitigate this risk by asking for full or partial recourse frequently. However, we've started to see a lot of 50% bank loans with non-recourse attached to it. Life insurance companies are non-recourse, so they mitigate their risk by lower loan to values. And then looking across property types, just to sum it up, multifamily and industrial are getting the most competitive terms. They're the preferred asset types, whereas retail and office are viewed a little bit riskier by lenders. The exception is multifamily in terms of loan to value. As everyone else is pulling back loan to value, multifamily is still stretching that out because of the agency influence. Going forward, most lenders are looking to add industrial properties to their portfolio. They're willing to stretch to do so. And life insurance companies and CMBS lenders have not yet hit their goals for 2017. So in the last half of this year, there is going to be a lot of options for borrowers still.